So today we're doing the watch list. And like I said, sometime last week, Bodie was going over like what to look for in the election and so on and so forth. But since Trump is coming in, what do we look for next quarter? It's going to be different. There are going to be different rules, different people involved, the sectors are going to thrive and die depending on what happens in the legislation. So it's a big opportunity. It's a really big opportunity to change our horses and get on fresh starts. But first, we are reviewing the watch list. And I last did the watch list review back on July 10th. And that was a update of the December 27th, 2023. So for the year, what we do is that at the end of the year, we start putting together a watch list for the following year, the things that we think will do well. Now, these are the ones from last year, obviously, from the old list, and what I'm doing is updating all of these first. So my first move is to give an update of where they are. So we started watching APD at 260, now it's at 328, it's up 42%, and there's nothing blue here, so it means that we're not likely to chase it or do anything with it at this point. We do already have it in one of our portfolios. That's a whole different situation. ARCC is still a strong buy at this level. We had it at 18, now it's at 21. Boeing, we had a 190, now it's 145 cheaper. And we think this is a good line to get in. See, 120 is holding way back here. That's when we thought they were completely dead. Now they're only recovering from death. So I think 140 is a fair line to be getting involved in, and we kind of like them here. We have them already, of course. Best Buy is another one we have. Barclays was the first thing we jumped on when we had the little financial crisis back here and everything collapsed. Barclays was the first bank we took. It got cheaper, we bought more, so we had plenty of Barclays. BXMT is a REIT that I really like. We already have these guys. Flat is okay for a REIT, and let's talk about that. A REIT pays out, this is what a REIT is. A REIT pays out 90% of its profits as a dividend. So they'll generally kind of forecast it in advance and they pay the dividend accordingly, but they have to pay out almost all of their profits as a dividend. Therefore, the stock is not going to appreciate very much because they're paying out all the excess profits. They're not reinvesting them, they pay them out. This is, they can invest before they pay out, but it's tricky because they have to get into fights with their shareholders and everything about who should get the money, and it's like, why are you taking out money and putting it into something else instead of paying out a dividend, blah, blah, blah. But meanwhile, they pay out ridiculous dividends. I mean, DXMT is paying out, I don't want to get the number wrong, but it's a big number. BXMT. And by the way, I don't really go by this because these numbers are wrong so often. Where is it? Dividend. Okay, so their forward dividends 10%, right? So you want to see what they actually pay. So you go to the historical data and say, what have these guys been paying? And whoop, what the hell? Historical prices daily. What the hell? I never seen that before. That's a new one. Oh, well. The one time I decided to actually talk about this is crazy. There it is. That was weird, huh? So the historical data shows you exactly how the dividend was paid. In this case, 47 cents was paid on September 30th, and 62 was paid on June 28th. And 62 is paid. So they lowered the dividend payment. And by the way, you can do a thing here, it's dividends only, and just look at the dividends so you don't have to do what I just did. But anyway, so they just lowered the dividend, but the dividend is still 47 cents, so basically $2, and $2 divided by 18 is obviously 1/10 dividend. So it is a 10% dividend. It's actually a bit better than a 10% dividend. So then we look at Blackstone and we say, well, they're going to trade pretty flat over time because they keep it. Now this is when they were getting very. This is when people were into buying the REITs and so on and so forth. And then in 2020 everything collapsed, and then they came back, and then they're here. But the bottom line is they're not going to jump right up unless sentiment changes. They're not really jumping around too much, but they are very, very low in their long-term channel. This is monthly from 2012. So, this is a great price. It's a strong company. They get it together. Their forward PE is only 12. And like I said, though, they're giving it all away, so they're not reinvesting and they're not really growing, but it's a nice steady number here. And what you can do with options is we can go to so we go to BXMT and we say, okay, how far out can we go? Oh, all the way to 27 is nice. So it's 1850. We don't think it's going to grow very much. So we buy the stock for 1850. Calculator, thank you. All right, so we buy the stock for $18.50 and we sell, let's be conservative, we sell the $17 calls. It's a little tricky to figure out what it is because it's not heavily traded. But let's say we sell these. I'm going to do a quick chart. Hopefully we can bring it up over here somewhere. Don't want that. Switch gadget. Quick chart. There's no activity here. That's not helpful. How about the 20? Quick chart. Okay, so we can get a price on the 20, and the 20 is 160. Let's see if we can get more information. Yeah, so as of yesterday, the 20 was 160, and the 17 we don't have a price on. Oh, there it is. All right, so the 17 as of what day are we at? As of two days ago was 215, 216. So then we go back to the Blackstone chart and we say, what's happened in the last 2 days? Well, it's gotten a bit cheaper in the last 2 days. So figure we can get $2 for the $17 call. That's net 19. You might get called away at the dividends. So that's not so great. I guess in that case, I would probably take the 160 for the 20s. That's a better deal, and it's all premium. So even if you get called away, you don't care. So we buy the stock for $18.50. We sell the $20 call minus 1.60 for the $20 call. And we say, you know what? If it goes down here, if it drops to 17, I'm willing to buy some more. So let's see what that looks like. And as of the 12th, it was $3, so it should still be $3 because we're lower than the 12th. So now we go minus 3. And it's net $13.90. So what have we done? We bought the stock, we sold the $20 calls, and we sold the $17 puts. So that makes our net $13.90. And if we get called away at $20, we have a $6 profit. As long as we're over 17, we have a nice profit of $4.10 anyway, and $4.10 is good money on 13. Not to mention, we're going to collect that 10% annual dividend, except now it's a 15% annual dividend because we lowered our cost basis. And what's the worst thing that can happen? The worst thing that can happen is that we're assigned another block of shares at 17, and that would make our basis $30.90 or $15.45 per share, which is still $3 less than the current price. So it's almost 20% less than the current price. if we're assigned. That's our worst case scenario, is owning the stock for 20% below the current price. Our best case scenario, we collect a 15% dividend this year, a 15% dividend next year is 30%. Plus, if we get called away with a 610 profit, if it's over 20, 6.1 divided by 13.9 is 43%. So 43% plus 30% is 73% in 2 years. That's a nice little play right there. That's why this one's in our income portfolio. All right, so that's Blackstone Mortgage Trust BXMT. See how it's good to review these things, right? Because you see these really good trades sometimes. Cheesecake Factory. They've gone up nicely finally. This is one that was flat for a long time that we liked, and then finally took off. So we liked it at 31.50, and now it's 46, so it's 50% up now. If they pull back, definitely want to get into them again. I like them a lot. What was it? 22 new restaurants. It's like 10% expansion of their total number of restaurants in 2024. And also what I like about Cheesecake Factory, they keep trying new restaurants. None of them have actually worked yet. Nothing has really taken off, but God bless them. They are constantly trying new things. Like Chipotle. Chipotle was a restaurant that got bought by McDonald's, and they changed it around a bit and manipulated it, and then it became hugely successful, and McDonald's spun it out, and now it's like as big as McDonald's is basically. That's what Cheesecake Factory does, but they do it very carefully. They set up one store, they test it, they try stuff. You know, they do it because, first of all, at the worst case, they learn how to put new recipes in their menu. Now Cheesecake Factory's menu is like 50 pages. So, you know, at worst, they tinker with their own menu as a trial in these stores. So even as an R&D, you have to look at it like an R&D budget, but also just in case, they're very happy if one of their store brands takes off and they start building on that. That has not happened yet. They have not had a really successful launch, but it hasn't hurt them either. All this experimentation, it's actually been good for them, and they learn stuff. So I like that attitude. You know, it's like, don't be satisfied with what you have. They open up lots of different things and try different things to see what sells in the market. Yeah. Chimera is the another REIT like BXMT, so the same story. I'm not going to get into the whole thing. You can do the same kind of trade. You can build the trade the same way, and ask me in chat if you want to do something like that. I can easily tell you. I just want to take up all this time. But it's the same concept as what we just did with BXMT. It's the same reason that what we just did with BXMT. There's no reason to expect it to grow much. So you just set up a trade that mostly gives yourself a discount. These guys are super cheap, and I strongly like them, and they also pay a ridiculous dividend. So we can look that one up. There it is. BIM. And they're also paying 10%. So it's the same thing. It's just fantastic when you're just collecting money like that. Now, Cleveland Cliff. The reason Cleveland Cliff fell off a cliff is because they were trying to buy U.S. Steel, and instead of buying U.S. Steel, they bought a company called Stelco, which is Canadian steel, because they just weren't doing. They gave up on the idea of buying U.S. Steel. It's too many moving parts and regulations and whatever. And I'm glad, because I really didn't like the idea of them buying U.S. Steel, but they were hot to trot. We knew they were going to buy somebody, so. You know, this price has gotten very, very cheap for them. I like CLF a lot. I don't think it's too risky at 12 bucks. We find this thing. There you go. Because you have to realize they're integrating Steelco's operation. This deal hasn't closed yet. It closes in November. And they're not really forecasting the difference of having the new operation yet. They're going to add to the market cap STELC. Now, see, they're not listed. But anyway, so it's not readily apparent, but you have to look at Cleveland Cliffs. They used to make a couple of $1 billion a year on the same sales they have now. So they're just in a trough. It's a cyclical business, and they're just in a trough in the cyclical business, but they're going to come back just like this. See this 293, 120, minus 122, 3 billion, 4 billion. So you're buying this company for $5.6 billion, and they're capable of making a couple of $1 billion a year. You know, they're not heavily in debt. They got $3 billion in debt, which they can service, especially if they make $3 billion. And they've got lots of working capital. It's a very, very, very strong company. It's and again, cyclicals. People have no patience for cyclicals anymore, but they're fantastic bargains if you catch them at the right point. And I think that's the right point for these guys. Oh, I'm sorry. I was going to look up the. So yeah, I'm sorry. So it's 5.6 billion. So right now the PE looks like 51 forward, but you have to just say, well, okay, we're in a low-use steel cycle, and if it comes back up, they're going to come back with the billions of dollars, and the PE is going to quickly go from 50 to 5. They make $1 billion, their PE turns into 5. So that's fantastic. And Cliffs is another one. It's another inexpensive stock, and you don't have to play it to go to the moon. So it's currently at not even 12, and we can go to 2027 and pick up pretty conservative. Now, what do I want to do? Do I want to go to 1015? Because 1015 is 475 and let's say 275. So it's a $3 spread. Wait, 475. Wait, 275, 47. No, it's a $2 spread. Sorry, it's $2 spread. It's a $5 spread in, you know, from 10 to 15, and you're buying it for net $2. So you can make 150% if they go to 15. But not only that though, but $10, you're paying $2 for the 10s. You're in the money. It's 100% of the money. It's just as good as buying the stock. So I like that, obviously, and that's without even talking about selling the puts, which I'd be very happy to sell these puts, because where's my risk? If I sell the $10 puts for $2, and they're more than $2, 205, 206, whatever. If I sell the $10 puts for $2, then what's my net? My net is 8. What's the price of Cliffs now? 12. So I'm getting 1/3 off. So my worst case scenario, selling the $10 puts, is I net into the stock for 8. Forget the rest of the transaction. I'm going to do that anyway, right? I already like that transaction. So if in addition to that, I sell the $10 puts for 8, so I'm promising to buy shares to net $8, my worst case is I own it for a 33% discount to the current price. That's not a worst case, that's a discount. You know, that's like going to buy a $50,000 Toyota and saying to the guy, okay, I tell you what, I'm going to give you 20%. I'm going to give you $10,000 as a put on the Toyota. And if the put goes below, oh no, I'm sorry, you're not even, I'm sorry, I apologize. You're not even giving the money, you're taking the money, they're giving you $2. So you go to the Toyota salesman, there's a $50,000 Toyota on the floor, you know you want it, and you say to him, hey, I tell you what, you give me 20% of the Toyota, give me $10,000, and I promise to buy it for $35,000. That's what you're saying to the guy. Say, I'll buy it. So the net would be, let's say the net's 45. So he gave you 10, and you'll end up paying net 35. He's giving you 10. You're promising to buy it for 45, and that's it. And you walk out of the store. You walk out of the store with $10,000. And the worst thing that can happen is he's going to call you up on the phone and say, hey, dude, remember I gave you $10,000, well, now you have to come and buy the Toyota for $45,000. And you're like, okay, that's not a problem. Or he doesn't call you, and the put option expires, and you keep the $10,000, and you can do whatever you want with it. You can go buy a Toyota, you can go buy any other car, you can do whatever you want with it. It's a term contract. That's what a short put option is. You're getting paid, you get paid for the right, you're getting paid to give somebody else the right to force you to buy something at a certain price within a certain amount of time. So in this case, what's going on? We're getting paid $2 or $2.10. So we're getting paid $2 to give somebody else the right to make us buy cliffs for $10, but we're getting $2 between now and January 2027. So at any time they do that, if they force us to buy it for 10, we have the 2, so we end up in the stock for net 8. 8 is significantly less than it is now. If they fail to exercise it, then we'd never end up owning it, and we just keep $2. And so that $2 will become part of the profit of this trade. It is highly unlikely that anybody would assign this to us for $10 if CLF is over 10. So as long as they're over 10, we're never going to get assigned. And if they do go below 10, all they can do is make us buy it for 8 of net. This is it's essentially a no-lose. If you want to own a stock, and that's why you should only do it with stocks you really want to own. But if you really want to own the stock, why would you not sell the puts? So you always want to be conservative, but let's say I don't mind owning 1,000 shares, and then I can easily sell 5 of these. I could sell 10 of them for $2,000, or I can sell 5 of them for $1,000. Either way, it works. But let's say simply I sell 5 and I collect $1,000 or $1,050. It would be for 5. Let's say 1,000 is easier. And I buy these spreads for $2, the 475 and minus 275. So that's $2. So I buy, let's say I buy 10 of those for $2,000, and I sold the short puts for 1,000. So now I'm in the whole spread for net 1,000. About 10 of the 2027 $10, $15 bull call spreads. Okay. Bought those for 2,000 for 10 times, 10 contracts times $2. So I bought that for 2,000, and I'm selling 10 of the short puts, and I'm collecting $1,000 for selling them. So now my net cost of the spread, 5 short puts, 10 long spreads, is $1,000, and it's a $5,000 spread. So if we hit 20, it's a $5,000 spread. But it's $2 in the money, so it's 2 times 10 is 2,000. It's 2,000 in the money. So I spent $1,000 net to be $2,000 in the money. I'm up 100% already. Not if I liquidate. If I liquidate because of the margins, the premium, I won't look like I won't actually be up 100%. But intrinsically, I'm up 100%. And if it all goes well, I'll be up 400%. I'll be up $4,000 if we hit 20. It's a fantastic trade. It's a lot better than sitting around waiting for the dividends. So the thing is, though, it's so fantastic. Do I even need to do that? It's too fantastic. So let's take a look at the 8s, which are up 570, let's say for the 8. So 570. 570 minus the 12s, which are, we decided was 375, although they're creeping up. Because you guys are buying while I'm talking, so stop it, it's screwing me up. So the 12s are 380, so minus 380. It's the same $2, but it's only a $4 spread. But it's a $4 spread that's already 100% in the money. That's kind of appealing. I might not mind spending some extra money on that one, So let's say instead of buying 10 of these, let's say we bought 15, still going to be times 2. So it's going to be 3,000. So let's say I spend $3,000 and I sell, but now I'm going to be more aggressive. I'm going to sell 10 of these. So I'm still going to be net 1,000. I'm going to sell 10 of these. So my obligation is to own 1,000 shares at 10, although it's going to be less on that side. It's minus $2,000. So my net cash is going to be $1,000 still. But now I have 15 times 4. So now I have $6,000 spread. So now my upside potential is $5,000 at 12, which is basically where we are now. So my upside potential is now 500% at 12. So the question is, am I actually that nervous? I am obligating myself to buy 500 more shares of CLF because we're selling 1,000 instead of 500 in this thing. But if you have the margin for it and you want to own CLF, why not? Because honestly, it doesn't have to move. It doesn't have to go up. And also logistically, that puts us in a better position to sell because now we have 15 long CLS, and let's say we sell 5. Let's say we sell 5. Oh, look at that. Oh, for sure. Because now we can sell 5 of the April 14s for $1. That's $500. And we only used 148 days. We have 786 to sell. So 786, 780, well, 786 divided by where was it? April 148. So 786 divided by 148 is 5 times. We have 5 times that we can sell short calls. And if we collect $500 each time, we're going to collect $2,500. I'm rounding down. We're going to collect $2,500 against our 1,000 spread. So we could actually collect against our net 1,000 spread $2,500 selling short calls while we wait. So now the upside of the spread is no longer just $5,000, it's $7,500. So by being more aggressive with the short puts, by being more aggressive with the spread, where we now have 15 $4 spreads instead of 10 $5 spreads, doesn't seem like much, but because we have a stronger net gain on our bull call spread, it means that we can afford to take the risk of selling 5 short calls, especially the 14s that are $3 out of the money. I mean, give me a break. It's more than 20% out of the money. It's almost 30%, it's 25% out of the money. And we're selling those in April, and we have all the time in the world to roll it. Not only that, it's not a very expensive spread, so it's real easy to buy more longs to cover if we can. It's like boo-hoo, because the longs are paying us 250% when they're successful. So yeah, I'll buy more longs with 250% potential in them to cover my short calls every time. So not only is this a great trade, this could conceivably be our trade of the year. This is an amazing trade. This is a trade that it's hard to imagine how you're going to lose this trade. In fact, let's ask Bodhi, let's ask our AI if he can figure out how we're going to lose this trade. Okay. CLF is at 12, and we are thinking of selling 10 $2,027 $10 puts for was it $2? That seems crazy. Is it really $2? As I'm doing, I'm like, really? Yeah, $2. In fact, it's $2.10. So for $2.10 and buying 15 of the 2027 8/12 bull call spreads for net 3,000 210 2,000. and buying 15 of the bull call spreads for net $3,000. And oh no, that's all we do. Oh yes, no, and selling 5 April $14 calls for $1 with the intention of doing that for more times for a total of 2,500 over the next 2 years. What do you think of the logic, and what likelihood, here's the key, what likelihood of, well, they do. Likelihood, no, how do you spell that? What is the word? Likelihood. Oh, there you go. Well, likelihood of success would you give it given CLF's go forward situation between now and then? This is not Bodhi. This is a platform I run Bodhi on, Complexity, but it's not a Bodhi. But it has some basic training for, we're experimenting with a different thing lately. This is something hopefully we'll be able to publish for people to be able to use. But as you see, it's kind of, I have to be able to get a language down so people can ask it in an ordinary question. Anyway, so net investment, blah, 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 is a $400 initial outlay, potential credits of $2,000 from future short calls. Final net position, net credit is $1,600. So anticipates a $1,600 credit. What's the risk? The puts assigned at 10 would cost $20,000. 10 contracts times 100 shares, it would be offset by the premium. The bull call spread could provide up to $6,000 profit at the thing. Needs CLF to be above 8 for the call spread to start paying, protected above 790 on the put sales. Cliff is projected to return to profitability by 2026 with earnings of $700 million. Revenue growth forecast to be 3.5% annually. Analyst coverage on positive with price targets of $10 to $22. The company shows strong cash flow projections. This strategy has approximately a 70% probability of success because the $10 strike provides significant downside protection, multiple income streams from all sales, reduced cost basis. Long-term outlook for Cliff shows return to profitability. Historical support exists around the 10 to 12 level. The main risk would be a significant market downturn affecting steel prices, but the company's projected cash flow improvements and return to profitability provide reasonable projection for the strategy's success. So there you go. That's something we're working on designing, because it's kind of cool to be able to say that, right? So say that, okay, you have 70% chance of success on this strategy, and when you have 70%, you have to understand though, 70% chance of success of making $6,000 on a $400 outlay has a 70% chance of being successful. It has a 30% chance of not succeeding, and that's another layer we could break this down to. There's a 30% chance of not succeeding, but let's say 20% of that is flat and not very successful or not successful, but 10%, only 10% chance of failing and ending up. And what happens if I fail? If I fail, I end up owning CLF at, let's say, completely wiped out. The position is completely wiped out. We only put in $400 net. Oh, wait, did we even put in $400 net dollars? Yeah, we actually put in 0 because we were selling those April. So we put in net 0 basically. Oh no, here it is, 500. Sorry, no, it's 400. So putting $400 net on 1,000 shares, that's only 40 cents per share. So that means that the worst thing that can happen is we end up owning CLF at 1040. If we got completely wiped out, if we recovered nothing from the options, if it went down so hard and fast that we were dumbfounded and stood there like a deer in the headlights, we'd end up owning 1,000 shares of CLF at 1040. That is the worst thing that can happen to us. It's currently 12 bucks. So we get a 10% discount on CLF that would be incompetent of us to not cash anything out, not quit, not reposition, not do anything. We just incompetently let the whole position fail, and we get assigned without rolling it, because we can also roll those short calls as well. That worst case scenario is that we have a 10% discount on 1,000 shares. That is our absolute worst. The best is a $6,000 profit. It's a really good risk reward situation. Really good. And that's what I'm trying to do. I'm trying to teach it to give me my risk reward outlay so that we can look at these positions and say, okay, so here's what I'm thinking of doing. What does that do to us? It's fun, right? Okay, Crocs. Hey, we made it through one more. Let's see if we have any questions. No questions. All right, fantastic. Crocs is another one. They are firing on all cylinders except one. They spent $1.4 billion acquiring a company called Hey Dude. I don't know why they did it. I think it was a terrible idea. It's already done 2 years ago, though, but they still are having trouble. That brand is not working for them. The kind of people who wear Crocs are not the kind of people who are interested in these stupid shoes. Hey Dude shoes, Crocs. I mean, nobody asked me. I used to be a business consultant. Nobody asked me these things. This is what Hey Dude is, and you know what a Crocs is. That's what a Crocs is. So there's Hey Dude. There's Crocs. It's not the same thing at all. What that's a Hey Dude. That's a Crocs. It's just I don't know. I mean, it's just a basic floppy shoe sort of thing. There's like millions of these kind of stuff. Crocs is like super unique, and this is just like why do I want that? It's like a moccasin sort of. They have a lot of different types though. I mean, and I understand Crocs probably said, oh, we're kind of limited, and we need to we need to have something else in the line. But it turns out this was not it. Hey Dude was a small little brand, and it was catching on in its niche, but it doesn't really mix with Crocs. That's the thing. It might have mixed with another kind of company that wanted a low end thing in their line, but it's just not working for them. I mean, it's $79 for that thing. This is $35. This is $64, $74, $50, $40. That's a cheap one at least. That's not Hey Dude. I don't know. And Crocs are $45, and those are kind of cool. I like those. Let me see that. That's a kid's one. Oh wow, that's kind of cute. That one's an alligator. They have much better ones for kids than they do for adults. Oh, come on. Can you transform them? I wonder if you can transform them from one thing to another. Look at that. See, that's adorable. Anyway, so good old reliable Crocs decides to buy another shoe company, and the integration has been a basic failure. The Hey Dude brand is losing ground consistently, and that's also because the Crocs' logic is we're going to not spend money on advertising. We're going to buy another brand, stick it next to our shoes on the shelves, and everybody's going to buy both. That's not how it works. They didn't build the brand. They assumed it was built, but it wasn't strong enough to support itself, and it started falling apart. Anyway, so problem for Crocs. And it really hurt them. I mean, this was Crocs before they did it. And then they spent 1.4 billion, which is a lot of money for these guys. Crocs is not a big company. It's the $5 billion company. They've got a few billion in sales. Here's their profit: 726, 540, 750. 750 is not bad. I mean, it's a $5 billion company making 750 million a year. That's a P of 7.5. But look what they did. They had no debt basically, and then they took on this company right here, and they went from 500 million in debt to 2 billion in debt. And now they're working it back down, but slowly. It's going to take them a couple more years to work it down, and it's a burden. And it didn't do enough to boost their sales. The sales went from 2.3 to 3.2. But look at how they were growing. Look how Crocs was growing. 20% more, 1.38. That's like 50% more in a year. 1.3 to 2.3 is another 50% growth. Oh, I'm sorry, this isn't 50%. This is 20%. This is not even 20%. Let's say 10%, 10%. This is 50%. Another $700 million. Then they bought Hey Dude. So this is artificial growth. They bought this growth. So they were coming off a great year. Their valuation was huge, but they knew internally they couldn't repeat what they just did. They weren't going to grow like that again. So instead they say, hey, how about we buy a shoe company? So it looks like we're growing that much still. And so they buy another shoe company, but the profits aren't growing because they bought the company for one thing. They get that, they're still growing internally though. They're still doing okay. And then they get to 4 billion. If they would have just left it alone, if they wouldn't have done this, they would have gone from 2.3 to 3 billion or more than 3 billion here by themselves without spending $1.4 billion on a wasted company. Bad decision, bad decision. But still a great company, still trading at 7 times earnings. It's like, you can screw up and still, it's like the Yankees. Or any sports teams. Well, now sports teams next year are going to start being like traded on the public market. It's going to be fun. Whole nother thing to talk about. But it's like you buy a baseball team. It doesn't have to be the Yankees. The main baseball team. These are Yankees. So you buy the Yankees, and they have a history of championships. Blah blah blah. They've got merchandising, so on and so forth. They got a fan base, so on and so forth. Great. So you buy the Yankees, but then you're running a team, and you're not going to win every year. Some years you're going to have building years. Some years you change your players. Some years you come close but don't make the championship. Some years you don't even get. You're terrible. It's still a valuable team if you hold the Yankees for the long term, like George Steinbrenner did, right? I mean, he bought the team for like $100 million and sold it for billions of dollars. So he made billions of dollars, not to mention the operating income of the team while he had it, right? So he made a fortune. But the next guy who buys it, runs a team, he makes billions of dollars too. He grows and grows and grows. Not every year is going to be great. Investors don't understand this anymore, though. They don't understand the concept of like having good and bad years. They act like a company can never have a bad year. They can never rebuild. They can never change their staff. They can never decide to go in a different direction. Our teams say it all the time, we're going in a different direction. We're gonna be more of a defensive team. If you decide that your football team is going to go from having, let's say you build your team around a quarterback, right, on football. Let's say you're the Vikings, and you got Fran Tarkenton, and he's like one of the greatest quarterbacks ever, but he's a scrambling, running, deadly aim quarterback. So when you're drafting people who are, you're not worried about protecting him so much because he runs like a maniac. And but you are worried about guys who can catch the ball, and so you draft wide receivers who are really good. You draft other kind of guys for different positions. But then he gets old, and you say to yourself, okay, well, we no longer have Fran Tarkington, so now we have to say, what's our future going to look like? And say, we think we have the tools right now. We have the makings of a great defensive team. No longer an offensive team. We're going to be a great defensive team. And we've analyzed what we have, and we think if we make a few changes over the next few years, we're going to become a great defensive team. You could be dead right about that, but in the current market environment, you would be completely, your stock would be trashed. So it's going to be so much fun betting on sports stocks because we get to do this stuff. People have absolutely no patience for losses. They can't take it. You know, when you have a rebuilding year, they don't want to hear about it. They will abandon you completely. These are not loyal fans. And it's crazy. It's going to allow us to pick up these sports teams at incredible bargain prices. I so look forward to it. But I mean, I almost feel like doing all sports. Because it's so contrary to the way people invest that I think there's going to be fortunes to be made on this stuff. You know, like the team fails to win the playoffs and the stock's going to go down 25%. That kind of stuff is going to happen just because you didn't make the playoffs. It's like, is that going to change your gate revenue next year by 25%? Are you going to sell beer, like 25% less beer next year and 25% less hot dogs and 25% less tickets next year? No, maybe 5%, 10% less, but is it going to change? And the marketing's still going to go up, and the TV rights and the sports and everything, and all your pays are going to go up, and they revenue share anyway, all the teams. So it's like, you know, people don't even understand the concept of what they're going to be betting on. I love it. I am so excited. Anyway, so, I love taking advantage of other people's lack of knowledge. Anyway, so Crux is having a rebuilding year, and they're doing very well in their rebuilding year. They're going from here to here. The arrow is going this way. This is their rebuilding. This is currently the bottom of the up cycle that they're going to. So they're going to go from here up. So this is an excellent thing to put money into. We already have it, but there you go. Now, CRISPR, unfortunately, great technology, great everything. We have an anti-science, anti-healthcare administration coming in, so we're probably not going to push them. It's sad. This is probably the future of humanity right here. And it's not, and it's gene editing. It's not just people, it's plants and animals and stuff like that, that they're going to have to re-engineer things to survive the heat. They have to maybe have to re-engineer people too, but certainly have to re-engineer animals and plants if we want to eat. In fact, I don't want to get depressing about stuff. Should have a note in front of my monitor. Don't talk about depressing things. Place your head in the sand and pretend stuff is not happening. Oh, come on. How am I looking at the other one? I don't understand how I can be looking at the other one if you are not going to let me in over here. Isn't that weird? Like, I shouldn't be able to look at this if the other one timed me out. La da da. A lot of work just to get to this thing. Oh, thanks. Oh, it's the same one I was on over there anyway. Let's see if we can even find it. Oh no. Anyway, it was a news item, but the news item was that we are facing insane water shortages. We're going to have to make some plays on water because we are facing extreme water shortages. We have messed up the water table so badly that, again, like I said, they're going to have to, this company, and others, like, if the Bible lets them, we have to worry about that now. Is the Bible going to let them do it? But CRISPR is going to be able to edit the genes of animals and plants to give them more survivability in hot waterless climates, which is what we're heading towards. And if they aren't able to do that, we may be facing like massive starvation and things like that. It's very bad, very bad. Anyway, Disney. Fortunately, we can all go watch some movies and escape. So Disney is back. We were banging the table on them because they were $88, which is stupid, and now they're $112, which is still pretty stupid. They've got challenges, but I like them, and they're doing a lot of good things. There's a lot of moving pieces. They just launched a brand new ship yesterday. Yesterday they launched a brand new ship. My daughter Jackie was at the launch, and she was loving it. They had a drone show and everything. It was really amazing. So they're adding 6 more ships to their fleet, which is doubling the size of their fleet of ships. And of course, they've got their parks, and they've got the movie revenue, the Marvel stuff. And in fact, Captain America, something is coming out early next year. That's a big one. And an Avengers. There's a Captain America and an Avengers movie next year. And when you say that, it's like, Captain America, there's $1 billion. Avengers, there's another $1 billion. You know, it's like that's money that's going to come into Disney. And then you have to say, well, does that move the needle? So you have to look at, well, is that going to move the needle? What is it? How much does it matter if they have a Captain America movie next year? And Disney takes in $90 billion. So the $1 billion, the revenue's not going to do it, but when they drop $1 billion to the bottom line, that's going to make a massive difference. It's going to make a 10% difference in their earnings. And in fact, look at where they are. They made $5 billion this year. They're estimating $10 billion next year. And that's, again, it's a thing people don't understand about Disney is it costs them in advance, let's say the $1 billion, let's just round them both up to $1 billion. The Avengers might be $2 billion, whatever. But it doesn't cost them more to make a $1 billion movie than a $2 billion movie, really. And it doesn't cost them more to make a it doesn't cost them much less to make a $500 million movie. Any blockbuster movie that's over a few hundred million is going to cost them about $300 million, $400 million to make. That's where we are now. So there's various reasons to make the movie, and this is the thing. Disney has more than one benefit for making a movie. Disney can make a movie that is only to remind people of their franchise. So in other words, Disney has their theme parks and their ships and their character sales and all this other stuff, and they've got their TV streaming. There's a whole bunch of different Marvel people on the streaming channels now at Disney Plus, and Disney Plus makes billions of dollars in revenues. So they're not necessarily, there's a Mandalorian movie next year now because the Mandalorian show on Disney. See, that's the thing. They make the show on Disney on TV, the Mandalorian. That becomes a hit. Now they're making a Mandalorian movie. They have a built-in audience for it. It's not coming out of left field. It's not something nobody knows about. It's the biggest hit they've got from the Star Wars franchise that they've run on TV is now coming to the movies. And they already know how many people are going to go. They already know how many people are watching it, when it's on the TV. So they assume that those people are going to go see the movie of it now, and maybe they'll pull in a bigger audience. So that's the Disney ecosystem. Like Apple has an ecosystem, Disney has an ecosystem. And each piece makes money in different ways, so it doesn't all have to be one thing or the other. So, and CNBC and MSNBC are getting spun out of Comcast. Comcast owns all that. They're dumping their little networks. They're keeping NBC, I think, but they're dumping MSNBC, CNBC. The little guys, or the little streaming services, are getting dumped. Not streaming services, whatever they call them. So those guys are getting dumped, and watch out for like Elon Musk buying them or something like that, and he'll take over MSNBC now. That's the new plan now, is like eliminate buy up all the liberal media, so there is no liberal media anymore. So where were we? Oh yeah. So Disney on plan right now to double their revenue, double their profits next year. Not double. They don't need to double revenue. They need to double their profits because, like I said, they're spending $300 million. They already spent $300 million doing the Avengers and doing Captain America. But next year now they're going to come out and they're going to bring back $1 billion on each of those guys. And so, oh, and I'm sorry, they're going to also spend a couple $100 million marketing as well. But that's another nice thing about that ecosystem thing is they have a built-in audience. They don't have to go crazy with the marketing to get you to go see it. You know, it's like people are just dying to know when the next Marvel movie's coming out. And that, by the way, is of course also good for IMAX, because people love to see those things in IMAX. So, you know, again, company like Disney can go through a year and a half, 2 years of building and you know, imagine the cost of building these ships. So they spent this money, they're building 6 cruise ships, probably for a couple of $1 billion each. They are building movies, not building movies, but whatever you call it, shooting movies. They're shooting movies and spending $1 billion, $2 billion making some movies. And none of it came out this year, and none of it came out. I mean, they had Frozen 2 or something or whatever they had. They had some big stuff this year, but it wasn't on purpose. They had a better than expected year, not on purpose. Their purpose year is next year. Next year they have a bunch of stuff coming out that's supposed to be a big hit. This year they had a couple of really nice hits that were not planned. Corey says, check out Target. We have Target on this list. Cody says, I was having technical issues when you were talking about Cliff. I'm a new trader. Can you please explain the process of one and how you roll positions and how to do it? Do you roll a certain type of strategy only? Sure. Oh no, it's very, very complicated. It is not a 1, 2, 3 thing. But you know, in the member chat room, let's talk about it. Okay. So when we come back to the member chat room, you want to work through that position. You can remind me every month and say, hey, how are we managing it this month? What are we doing this month? Aside from the fact that obviously we do our trade reviews every month. But you have to let them play out. There's no, it's like explaining the chess, it's like explaining what you're going to do in a chess match and trying to explain where you're going to be 5 moves from now. 5 moves from now, there's 125 possible things that could happen. Because you make 5 moves and the other guy makes 5 moves, and for every move you make, it's probably more than 125. For every, okay. How many possible moves can happen? 5 moves into a chess match. Oh, it's a lot worse than I thought. 1.8 billion. Okay, so that's the problem with that question is that it's just like chess. There are 1.8 billion things that can happen 5 moves in. So when you say, what about the roll and what's the strategy here and this and that, we're planning on 2 years worth of moves, and every month there's an adjustment or you look to see what the market does, and the market could go up, it could go down, it could go sideways, the value of the options can change, the VIX can change, news about the company can change, the stock price obviously can change. So you think about a chessboard, there's just as many variables as there are on a chessboard, right? There's all these different things that could happen, and and you'll do something, and then the market will do something, and then, or it can do, and even worse, it can do more than one thing. 2 different things can happen at the same time. It's not limited to one move. The price can change, the VIX can change, there can be tariffs all of a sudden. China can put a tariffs on US steel or something like that. There could be import taxes, shipping charges can go up. There are a bunch of things that can change at the same time that will then affect your next move. And now your next move can be one of several things and it gets exponentially worse every single time you look a little bit further down the field. So there's no first you do this, then you do that, then you do that. It doesn't work that way. That's why, you know, the goal here is not to teach you or not to show you how to do something, but to teach you how to do things so that when the situation comes up, you know what to do. You know, like there's no manual that says how to do a heart transplant. You know, there's no like quick study guide or like an IKEA thing. You know, like IKEA thing of like a guy on the operating table and be like, here's what you do in step 3. There's too many possible other things that can happen. Therefore, you can only train people to be good surgeons. You can teach them the basics of each step, but the most important thing is that you are able to understand the variables and make your adjustments accordingly. You know, you can read the rules of baseball, and the rules of baseball is actually a very small book, but you can read the rules of baseball until you're blue in the face, and you can memorize every single line of it, but that doesn't mean you can play a game. That's a whole different thing. So, you know, that's the non-answer to that, is to say that, yeah, you have to do it, and I tell people all the time, the best thing to do is to, if you haven't done this before, you should open up a practice portfolio and spend a good 6 months practicing. Don't start trading right away. You don't have the experience. Practice trading. Open up sample portfolios that have, virtual accounts in them, and work on those until you feel comfortable trying a couple of new positions. You can't jump right in and say, I'm going to put $100,000 to work tomorrow. You got to learn this stuff properly. It's simple when everything's working properly. It's not when it's not. Now here's Ford. Ford hasn't gone anywhere in the time we've been playing it. It was 1163 and it's still 11. So Ford's a good stock to play to keep being flat. And I love Ford and I want to play it. So it's a definite. We already have it, of course, but we like it. Future Fuel's another weird one. It was 406. Now it's 520. So that's good. They've actually gone up. Super cheap. The problem is clean energy. It's a clean energy stock, and this is what's happened since Trump got elected. People have drastically lost faith in it. If there's no incentive to use clean fuels, then what's going to happen to that industry? Because it's not cheaper. It's cheaper to use fossil fuels, but it's not better. Foot Locker has gone nowhere. It's actually lower than we started. They were doing good, then they went down. They have a tough time. But off, you can see nothing blue, so they're not recommended here. Gilead, it was so stupidly cheap down here. I couldn't believe it. Now they've come back, but this is the right price, 80, 85. I'm comfortable in that range. So certainly worth watching. Oh, and by the way, it's really important. This is a watch list. We are watching these stocks. This is not a buy list. There's a very big difference. These are stocks we watch, and when they go on sale, we say, oh, isn't that on the watch list? And then we look back and say, why did we like them on the watch list? And if they got cheaper, do we still like them? If those premises still there, or has something gone wrong? So that's what this is all about. So when I go to GNRC, I say, why do you like GNRC? We like GNRC because there are going to be a lot of natural disasters. This was my prediction back in the day, and it's cheaper than it was. I'm sorry, it's much higher. It was at 100. I just thought it was stupidly cheap. Now it's 179. This is about 20 times earnings. 20 times forward earnings. Sorry, it's currently 40 times earnings, but they're going to make a lot more money. They're a great company. We do own some of them in the long-term portfolio. They make generators, and my logic at $100 was then that was trading at 10 times earnings back then, and I was like, well, they make generators. There's a lead time to making generators, so they can't grow as fast as people want them to. But the reality is the demand is going to be there because nobody can make them faster than they're making them. They're making them as fast as they can be made. without billions being invested, which isn't going to happen. But what does happen is there's a worse and worse disaster, and more people lose electricity, and a certain percentage of those people say, that's never going to happen to me again, I'm putting in a generator. And so exactly as we expected, there have been more floods, more tornadoes, more hurricanes, more losses of power, and more wildfires and things like that. And every time, because they don't sell that many, they're not such a big company. And I'm talking about all the generator companies together. They're not that big. So when a few thousand people from a hurricane out of millions of people who lost power decide they're going to buy generators, that's taking up a half, like their whole quarter's worth of supply all of a sudden. So that's what happens. There's more and more and more people who just get fed up with having their lights turned off on a regular basis, and even more, it spreads because now those people have more and more neighbors who go, hey, I have a Generac, it was great, everything was on. So it's a great growth business. It's going to be a great growth business for many years. So I like them. They're a little hot now. They were very cold here. They're getting hot now. They're still buyable. They'll probably sit in this range for a while, which is a big range, 150 to 200. But they'll probably stay in this range for a while, and then they'll break back up again. So if they go down, we will be happy to jump in. Gold. It's another one. Every time they go down, it's like, holy crap. This range is so reliable, this $15 range down here. When they're at $15 or even $16, they're totally a buy. And when they go up over 18, they tend to become a sell. They shouldn't be, though. The reality is gold is going to go to 3,000 next year. It's at 2650. The 2650 now. Next year will be 3,000, which is up 10%. But that's not the story, because gold, the company Barrick Gold, this one, GOLD, the company Barrick Gold, they extract the gold from the ground. And so what matters for a gold miner is not the price of gold. Well, the price of gold, but it matters differently, because the price of gold, if they're extracting the gold for $1,700, if it costs them $1,700, that means buying the mine, paying the people, buying the equipment, doing whatever, paying the traders who trade the gold, all that. Let's say their all-in cost is $1,700 an ounce to have gold out of the ground and put in the market. So if gold is trading at $2,300, they're making $600, right? But if gold is trading at $2,600, they're making $900, 50% more, not 10% more, 50% more. And if gold goes to $3,000 and they're still extracting and they're still all in cost is 17, now they're making $1,300. It's 100% more money. So it doesn't take, that's why I like the miners, because they're a leverage play against gold. So when gold goes up, they go up exponentially to what gold goes up. That's why miners is such a great way to play gold. And also, Barrick Gold has 76 million ounces of proven reserves in the ground. Now proven, they have unproven reserves, double that. But of stuff that's been measured and tested and certified by scientists and all that, they have 76 million ounces of gold in the ground that are mineable at the current technology level. So when you say proven reserves, it means that given the technology they have now, and given the situation, given the position of the gold that they own and where it is in the ground and so on and so forth, they are able to mine 76 million ounces of gold out of their reserves. Unproven means that if there's gold here, here, and here, there's almost certainly gold there, but they haven't found it and tested it yet, right? So if you have you know how gold is like in veins in the rocks? So if gold is in 8 places they tested out of 20, and in a concentration of such and such, you can expect that in the other half of where they didn't test, that it would be similar or maybe at least half of that, but not none. That's almost impossible for it to be none, but they haven't proven it yet, therefore they don't count it. So you don't know what they have. They could accidentally have much more gold than they ever imagined. But proven reserves is what we go by. But when you look at 76 million ounces of gold. Wait, too many zeros. 76 million ounces of gold times 2,650 per ounce is $201 billion worth of gold, right? And you're buying the company for $30 billion, and they have $200 billion worth of gold. But don't forget, there's an extraction cost. So if the extraction cost is so if the extraction cost is $1,700 times 76 million, $129 million is the spread. All right, but they can also only take out about 5 million ounces a year. That's what they're currently extracting. So now you have to say, well, let's see, if it's 76 million ounces of gold, it's going to take them 10 plus 15 years. It's going to take them 15 years. So we divide that by 15. So that's their cost every year. And their profit is 200 divided by 15. 13.3 minus 8.6 is $4.7 billion. And look at what they're projecting, 3.5. That's net, don't forget anyway. So that's I'm sorry, it's gross profit. So gross profit is 4.7 billion a year, and that's basically what they're projecting. Yes, taxes and crap. So down the road, that's what we can expect. But the thing is, the variable is now costs go up, of course. So the costs do go up, but if they can get keep the cost down and the price of gold keeps going up, their margins increase very, very quickly and they make a fortune. That's not true at all if you have physical gold. If you have physical gold, you're only going to make the money that the gold goes up. So you are way better off owning a miner if it's a good, strong operator, and this is the best operator of them all. They are the biggest miner in the world. They've got the most reserves in the world. Every reason to stick with those guys. Now, there's another one called NAK. They've got massive, massive gold reserves, but they're not allowed to touch them so far. And why though? Environmental issues. And who doesn't care about environmental issues? Donald Trump. So it is possible that this could be the greatest gold miner you could ever invest in. NAK. They have massive, massive reserves in Alaska, but the mines are right next to salmon fisheries. So in order to for them to be able to start mining the gold, it's worthless if they can't mine. It doesn't matter how much is in the ground. But if they are allowed to start mining there, and it's not that it's going to immediately kill the salmon, it's that if there's an accident, like the kind of accident that Vale and BHP just paid $25 billion because a dam that they built collapsed and destroyed an ecosystem, so they got fined $25 billion. If that kind of accident that does actually happens, then it's not so much the money, it's that the Alaskan salmon fishing industry will be destroyed, and as will the salmon. And it will be an ecological, environmental, economic disaster of biblical proportions. So this company, Northern Dynasty, has submitted plan after plan after plan to the EPA that says, oh no, we're going to make sure of this and we're going to make sure of that, and we're going to build these walls to retain the runoff, and we're going to make sure nothing gets into the ocean, and blah, blah, blah. And the EPA has been, and this has been going on for 12 years. This has been Obama, Trump, and Biden, all their EPAs have told these guys, no frickin' way, this isn't worth the risk. You know, you're a bullshit $250 million company who has the rights to mine this area, which is, by the way, protected area anyway, a protected area. You have technically the right to do it, but you don't have a plan that makes us comfortable that you're not going to wipe out the ecosystem when you do it. There is no way we trust you to do this, you stupid little $250 million company. So the new EPA, the guy who's heading up Trump's EPA, who's the Fox News guy, I think, basically is like saying, well, our first move is going to be to take away all these silly regulations that are stopping business. If this works, these guys could fly up $2, $3, $4, whatever, in very, very short amount of time, because they are sitting on a shitload of gold. They're only burning $20 million a year. So they keep getting money to keep the thing alive. It's costing them $20 million a year, but they've got to at some point be allowed to do the mining. It's 0, 0, 0, 0. They're not allowed to do anything. So all this is just legal bullshit that they go through constantly to try to keep their thing alive. But if you want to play a lottery ticket, this is the greatest lottery ticket in the world. Because if Trump's EPA allows them to start mining, people in Alaska are going to freak out, for one thing. That's one thing about it. Because their whole, the main industry in Alaska is salmon fishing. So you're gonna imperil their salmon fishing so these guys can grab some gold. But it's a lot of gold. It's almost as much gold as Barrick Gold has, and Barrick Gold is worth 30 billion, and they're worth 250. So you're talking about 100 times potential gain on this thing. So that's fun. Got questions? Bill, I saw you using Perplexity. Can you post a prompt? Sure. Where'd you go? Da, 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 da. Oh, there you go. Can I put the answer there? There it is. All right, so there's that. What else? Honeywell. What did I say about Honeywell as well? Well, they're benefiting from military crap, and anybody in that space is going to be strong. IMAX, lots of good films coming up. Very strong holiday stuff. Like I said, next year Disney. What's good for Disney is good for IMAX generally, because almost everything from Disney comes out in IMAX. There's other good stuff. Wicked. Okay, well, look. You know what? IMAX is very, very bad about publishing what's going on with them. IMAX upcoming movies. Let's see. But this is what you got to do. You got to go through it. So Gladiator getting good reviews, so I imagine it's going to be a good 500 million plus. Wicked looks like it could be one of the biggest movies of all time. It's crazy. I mean, I can't believe the press this thing is getting. It's amazing. I thought it was Disney. It's not Disney. It's Universal. But so this is getting great buzz, and Wicked comes out like this week, I think. Wicked's going to be the Thanksgiving movie. Red One is the one with The Rock, where it's something to do with Santa Claus and stuff. That'll probably do well. Oh, Moana, that's a guaranteed $1 billion. These are those are whatchamacallits. These are the sciencey ones. 2025. I don't know what that is. 7, but it's something. I don't know what that is. What is this crap? There's Captain America. Thunderbolts. I don't know what that is. Doesn't look very good. Oh, here you go. Mission Impossible, How to Train Your Dragon. So you got to look at their schedule. I can't believe they don't have like a proper schedule though. You can see what's coming when. When you think it would be just like printed somewhere? IMAX release slate. Oh, here you go. This is Reddit though. Oh, that's not useful at all. Seriously? Oh, Reddit is so annoying. What does this say? That's not big. Oh. Okay, so, oops. So Joker just did well. Red 1, Gladiator 2, Wicked, War, something, I can't read that. Can I make this bigger? Does it have a thingy? I don't see anything to make this bigger with. All right. Craven is a Spider-Man-y thing, so that should probably do pretty good. 2025, Untitled Chinese New Year. That's weird. Mickey 17, no idea what that is. Captain America, obviously the $1 billion movie. Untitled, Ryan Coogler, and who knows. I can't even see what that says. This says Michael, don't know what that is. Thunderbolts. Anyway, what we care about is what's coming up soon. And what's coming up soon is Wicked, that thing. Craven is a Spider-Man, that's a good one. We don't know Chinese New Year. Mickey 17, no idea what that is. Captain America is a huge one. So we're good until March. Then it looks like maybe a little bit of weakness coming into the summer. Don't know what Thunderbolts is. Don't know what that is. I can't read that. How to Train Your Dragon, though, we know is good. Superman, obviously, always a winner. That, God knows what that is. God knows what that is. Well, are you supposed to know what these things are? It's a Marvel of some kind. Something called Mercy, The Bride, Tron. Ugh, really again? Mortal Kombat. Avatar again? Wow. Wicked. Oh, Wicked Part 2? Oh, you sons of bitches. No one said it was Part 1. Has anyone said the Wicked is only a Part 1? Oh, people are going to be so pissed. Wow. No idea. Avatar. Then it goes further. More Avengers. Mandalorian. There's a Mandalorian thing. Oh, that's 2026. Supergirl. Moana. Is that another Moana? I'm milking that one. Untitled Dune. Dennis Villeneuve. Avatar again. What are you going to make Avatar every 6 months now? Mario Brothers 2, Toy Story 5. Wow, Shrek 5, Batman. Whoa, that looks like a good year to watch movies. So anyway, well there you go though. So there's some very strong Disney and IMAX and so on and so forth stuff going on here. A little bit of a bump, and this is the thing about investing in IMAX. So it's funny because you can pay for it, it'll do good, and then what will happen is there'll be just a couple of slow months and they'll ditch the stock and they don't pay any attention at all to what the slate looks like and what's coming up. So you gain a tremendous advantage just paying a little bit of attention to what's happening in the market, which is what we do. We're like, okay, you want to sell it to us now, we'll buy it, we don't care. International paper already took off, so kind of not paying attention to it now. IVZ, very, very strong, very, very good. We like these guys down here. Jack in the Box, like them down here. They're expanding to the East Coast. And again, investors hate this. Oh, it's insane. We're spending money to expand. We're going to have a lot more stores and we're moving into an entirely different part of the country. And everybody's like, oh, no, you can't do that. Like, how are you supposed to grow a business? It's so ridiculous. So I like Jack in the Box. I think they're going to do great in other parts of the country. Also, they're going to diversify themselves away from the California wages And although you would think they'd be going up because California just voted down $18 an hour, they were going to vote in $18 an hour. It has to be everywhere in the country, and they voted that down now. Nordstrom's rich people are still shopping, but it's an iffy bet if the economy collapses. KLG doing very, very well, a little too well. Can't really play after them. This is a Kellogg's cereal. This is the Kellogg's broke up, and this is the cereal division of Kellogg's. So you know, but I mean, I forgot what the number is. I don't want to say a number because I swear it's like $10 for a box of cereal or something like that, and it cost like 50 cents to put the cereal in the box. It is disgusting and ridiculous, and they're making a fortune. But I mean, you talk about inflation, it's complete bullshit. Kraft Heinz, and they're down also. Another one that's, you know, companies like that, they have to adjust to inflation. It's like it takes them a while to push the prices through, but once they push the price increases through, they do very, very well. Coca-Cola, same thing. Coca-Cola's got to find the right price and figure out the right mix for the consumers, and they'll get it going. And who the hell bets against Coca-Cola? That's just idiotic. They're not cheap. They're trading at 20 times earnings. They should be at 15 times earnings, so we're not going to jump on them. But if they do come back, we like it. Lebu, the biotech ETF. The problem with the biotech ETF is that it's a 3 times ETF, and it churns and churns and churns its holdings. So although they tell you that something has a 1% fee structure or something like that, what they don't explain to you is that if they're going to roll over their holdings twice a month, it's going to cost you 2% a month. The 1% is hitting you constantly with the rollover, and they structure it that way on purpose. So it sounds like they don't have a big load, but they hit you with it over and over and over and over again, and it just drains out the money and eventually goes bust. So it doesn't matter how good the stocks are, it's just a way to steal money. Most of those leverage ETFs are. Levi, if they execute from here, they're really, really good. They're being sold off to like 12 times earnings for next year. But again, currently not performing because they're rebuilding. Dockers, yeah, they're going to have to dump Dockers. So it depends on how much they get for that. Then the stock will take off. Lean Forward makes a, I want to say $30,000 exoskeleton, and it's not that fancy. Hell, keep hitting the wrong key because my keyboard's at a funny angle. Lean Forward rewalk. So that's what they do. So if you're bound in a wheelchair, they can put this on you, and it's an exoskeleton. It's a robotic system, and you can walk around. There's, you know, strap to your legs. You can get out of your chair, and there's what it looks like in the chair. You can get out of your chair and you can walk around using this thing. It's motor assisted. It runs on batteries, and it's amazing. I mean, obviously, I mean, just think about the difference in your life if you can actually like get out of a wheelchair for the first time and whenever, and walk around and do things. So the problem is though that a wheelchair costs $500 and this thing costs, you know, $20,000, $30,000. They got FDA approval, but you have to get approved that Medicare will pay for it. Otherwise, there's no point. Because the people can't afford it. I mean, obviously some people can afford it, but the majority of people can't afford this sort of thing. So technology-wise, it's great. They got the FDA approval we expected them to get, but they didn't get approval for Medicare because it's, it's a big drain on the system. They don't like to approve fancy solutions. The thing is that, when you're approving something for Medicare, it has to have a serious impact on the patient's life. So yes, this does, obviously, but they have to determine, and there's politics in this stuff, because they have to determine that it's worth it. And who's making that determination? It's not up to the people who are benefiting, it's up to the people who are watching the books for Medicare. And they're basically saying, and this is going on all over the world, it's not just in America, this is all of the healthcare plans all around the world are looking at this thing very, very carefully and being like, are you really giving us that much value? And obviously the answer to a person who's stuck in a wheelchair and gets to walk around and participate in ordinary everyday life, they're going to say, yeah, why not? But the way these healthcare systems look at it is they look at it and say, well, you could go to the store by taking your wheelchair and going to a special van that'll come and pick you up. It's a government service we already have, and it takes you to the store, and the store has a ramp, and you go shopping and you come home. How does this change that? It changes it because I can walk to the store myself and walk around the store myself and not have to ask people to help me for everything I get. And I feel like I'm a person, participating in society. It's not enough. That's the problem. It's very sad, but that's what we do. We actually place a cost on it. The same way, by the way, that they place a cost on human life. A car should be this safe, but not that safe. Even though obviously if it was safer, it would save lives. How many lives? Well, we could save, let's say 250,000 people die in an auto accident every year. And you say, well, if we made the car, if we put all the airbags like Mercedes has, like it has airbags in every possible place. If we had all around airbags instead of just several airbags, it would save 10,000 lives, but it would cost $80 billion of additional cost of cars. And they say no. They say 10,000 lives isn't worth $80 billion. End of story. That's how decisions get made. We make decisions of people's lives all the time. And obviously those people who died, because instead of being hit head on, where the airbag works effectively, they get hit on the corner of the car, and they move to a place where the airbag isn't and slam into something that in a Mercedes would protect you, because the poles of the door, where the doors are, those things have airbags too, and they come out and they protect you there too, but not regular cars because it's too expensive. Yet there's some guy in government who makes a decision of whether or not it's worth putting in that other airbag, and they decide based on the fact that your life isn't worth that much money. If it costs $80,000 per person whose life we save, or $800,000, probably $80,000 they do it. So let's say it costs $800,000 per life saved to do it. They'd be like, no, $200,000 is the most we spend to save a life. But will they spend $20,000 to improve somebody's life and give them better life satisfaction? And especially considering that most of these people who need these things are vets. No, they won't spend that. Very sad. It's very pissed me off, because I really like this company a lot. I like what they're doing, and it makes me very sad to watch the journey this company has been going on, where basically that's what it's all about. It's not worth it to enhance people's lives. Yes, you invented something great. It's fantastic. It does exactly what you said it would do. It works perfectly. People are thrilled with it, but the government's not going to pay for it. Shame. Love sacks, however, are very expensive, and people like them, so they buy them. There's enough rich people to buy these things. And they went through a retooling, rebuilding, coming out of COVID disaster, all that stuff. They're getting way better. They're on a great ramp up. They still have to prove that they can keep growing and maintain their margins, which they haven't been doing lately. But if they do that, this is fantastic. I love them. Las Vegas Sands, Too tricky with China, unfortunately, can't stick with that right now. McDermott, oh no, Medtronic, not Meddermott. Medtronic is, you know, medical devices and stuff, obviously with the aging population, but again, boom, look what happened. Trump gets elected and who knows if they're gonna pay for anything. So we don't know if healthcare is gonna exist in a couple of years. And I mean, again, we're back to that whole thing where now we're going to have the pre-existing conditions won't be allowed and they won't transfer. If they kill Obamacare, you're going to have 40 million people suddenly off of healthcare again. And that's a decline in their customer base, so they can really hurt these guys. MGM, same problem with Las Vegas Sands. You can't trust the Chinese market. Middleby makes ovens for commercial kitchens. That's their main thing. They also make Viking grills. But, you know, I think the bigger money comes in from the commercial side. And again, you don't know what the economy is going to be like. You don't know what consumer discretionary is going to be like. What's the market going to be? And if you want to pay attention to this company, you want to watch how many new restaurants are opening. Okay, now new restaurants don't always need a new oven, they take over existing restaurants, but if you see a lot of new restaurants opening up, that's a good sign that something's good's going to happen for these guys. I do like them though long term. MP is Earth, rare earth, and we like them a lot. This is a great company, so I think this one long term, I can't see how we can do without the rare earth materials. Moderna, oh my God, they got crushed, and now Robert Kennedy is in charge of vaccines. This is a vaccine company. So I like them for the long term, but you've got to be ready to ride out in a very, very rough 4 years of anti-science bullshit in order to stick with these guys. Metal Steel is European steel. I certainly like them. And again, though, you got to watch the global economy. Nike is Nike. That's, again, this is silly. Although they're not that cheap. I mean, it's you know, we do have Nike. NKE. What? No, oh, NK. Why is that not showing up? You have to pay for each country, by the way, in this thing. It's really annoying. 24 times earnings. This is still 24 times earnings. And they're not, you know, the growth is okay, but it's not spectacular. You know, they were doing 45 billion in 2021. They're doing 47 billion now. This is not a high growth thing. So it's tricky for Nike. And one of the problems is though they based their marketing on getting these superstars, right? And to be their brand ambassadors. And Michael Jordan's been the guy for like 30 years or something like that, or for however a long time, right? Was Jordan the 80s? No, it's 90s, I guess. So yeah, about 30 years of Jordan. If there's not a lot of breakout stars and the stratification of sports across all the cable and everything like that, is that everybody's not exposed to everybody the way they used to be, and there aren't these. It's harder to have these mega stars in the sports business, even though they're getting paid insane amounts of money. It's not that there's one or two standout guys who are so famous that everybody knows their name and so on and so forth. That's been a problem for Nike, and they're struggling to adjust to that because that's how they used to move sneakers. They used to move sneakers by putting some guy's name on millions and millions of sneakers that everybody would look at it and say, I know that guy, I want to be that guy. And you got to say to yourself, who would that be now? Who does everyone want to be? What shoe does everybody want to wear? Who's the guy? You know, Trump may have had a point. He put out his own sneaker. Trump is probably the most recognizable single person on the planet. So they're going to have to figure out something and come up with a more of an iconic marketing scheme or change their ways. But that's hard. You know, Nike had a unique thing. They paid top dollar for the most recognizable people on the planet, but people aren't as recognizable as they used to be. NLY is essentially the same company as CIM, essentially the same premise. This is a real estate, the real estate investment trust. Same play. In fact, right at 20, that's the thing. It's a great time to buy them because at 20, you're going to get some great prices on the options. So they're at 1950, and it's the same kind of thing. We want to take, you know, and again, paying 10% interest or more than 10% interest. We buy it for 1950. We sell the 20. No, I'm not going to sell those. That's a toughie. Oh, they don't have 19 calls. That's so annoying. Do I want to sell the $20 calls for $1, or do I want to sell these guys for $1.85? See, if I sell this for $185, that's only $19.85, and they're at $19.44. I guess I would do that though. I'd rather have the protection. So in this case, we would buy the stock for 19.45. We would sell the 2027 $18 calls for 185. So minus 1.85. And we would sell, oh, this is where you get your money though. And we sell the $18 puts for $3.30. That's fantastic. There's where your money is, 3.30. And now we're in for $14.30 with a call away at 18. So that's 370. So 370 divided by 1430 is 25% on the stock if we get called away at 18. We sold the $18 puts, so it'd be the same thing. The puts would expire worthless. And we made 25% on the stock. And also, since our net was what, 1430 was it? Now we see what the dividend was. NLY. Yeah, they have a better dividend, 260. So they are paying they're paying 65 cents. So when you're collecting 65 cents, whoops, 65 divided by 1430, that is 4.5% a quarter. That's 18% against your net per year. So you're getting 18 plus 18 is 36, and 36 plus 25% when you get called away is 61% in 2 years between the dividends and being called away. And your worst case scenario is you get the stock for $18. You know, you get assigned the stock. If it's lower, you'll end up owning it for 18, or you'll end up owning more stock for 18. You already bought some. I'm sorry, since you bought the stock for net 1430, you're going to end up averaging about $16 from that. So you're going to get almost 20% off the stock. So I love that one too. That's a great trade. And when I say great trades, I mean safe, conservative, very likely to be successful, that kind of thing. Not everything has to be risk. If you make 30% a year for 2 years, you're doing very, very well. And if you can do that consistently, you will become a wealthy, wealthy person. There's no need to go after everything. Doesn't have to be these ridiculous returns. OLN, not really a buy right now. Paramount's so annoying. We've run the math 100 different ways. We should be getting 1250 when this merger goes, when this acquisition goes through. But nobody believes it. Nobody believes this is really going to happen or whatever. And in theory, though, we're set up for 1250. We've got all of next year to wait, so we're waiting. But it is crazy that this stock is not 1250. Since it's 1044, though, you can change the game. I think you want to own the stock. So that's 1045, 10.45. You sell the $10 calls, and it looks like 180. Make sure that's what they're actually selling for. What day is this? Yep, 180 as of today. So it's 1044. You're selling the $10 calls minus 1.8 is 865, and you sell the $10 puts for 280. Because if you get called away higher than 10, those expire worthless. So you sell the $10 puts for 2.8, and you're in for net 585. There's no dividend here, but you're in your shares. You buy the shares. You're in the shares for 585, and if the stock gets called away at $10 or higher, you're going to make 415. 415 divided by 5.85 is 70%. So assuming the merger closes next year, in less than 1 year, you can make 70% with that simple spread. You buy the stock, you sell the $10 calls and the $10 puts, and your net is 585. And then if you get called away, you're going to make 70% if you're called away at $10. I can't really see how that's not going to work, but who knows? It's gotten this deal has never gone through. It never works. It keeps going lower and lower and lower. It's so freaking frustrating that I can't really say I recommend this, but I really can't believe that's not going to work. Here's Rocket Mortgage. Those guys not really performing how we want them to, so we're going to stay away from that. Here's RH. I love RH. I really loved RH at 300. Now they're at 330, so I still like them. They did a big, gigantic, they did a huge reorganization. RH used to be a hardware store, high-end hardware store, and they had a great niche market of like every luxury home in America would basically be using RH because there was not really much comparison to what they had. All the fancy fixtures and the best stuff and so on and so forth. So they were doing great. They were doing so great that they decided to build themselves up from this simplicity to become the luxury fitter of airplanes, living rooms, design, interiors, blah, 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 everything else rich people want. I think it's a good long-term strategy. It's just a terrible short-term strategy because they're spending money. And you're not allowed to spend money to build your business. You're supposed to build your business by magic. They even changed their name, use Restoration Hardware, of course. But they were there. So this is 2021. Is even during COVID. So during COVID, 2.5, 2.65, 2.84, nice steady growth. And profits were 136, 220, 272. Here they had a expansion or whatever, but then they're spending all this money to get into all these different things so that they can pave their path. Because here they run into a dead end here. They're like, we're not going to get to $1 billion. We can't make it to $1 billion because we don't, hardware itself isn't enough to get us to $1 billion. So they start redoing themselves and making it so they have a huge line. But in doing that, they slowed themselves down. They're spending money internally, so on and so forth. They're just starting to build it back up. They're going to go right back to 272, 689. But they're going to go past 689 and get to $1 billion now. But they had taken on debt. Look what they did. They spent their net debt went from $1 billion. It was going down because they made so much money that year, and then they immediately went the other way and spent $1.2 billion more than they had, and then they spent another $1.3 billion more than they had, and now they stopped. Oh, I'm sorry, they haven't stopped. That's TTM. So Then they spent, so they went massively into debt. Now they got $3 billion worth of debt, and they sure as shit aren't going to be able to pay it off with those numbers. But they believe they're going to make $1 billion a year going forward, and this money is going to mean nothing. But as it stands right now, it's a little scary. Look what happened to their earnings per share. Look what happened to their net income. All right, so a little bit scary, but I still love these guys. I think it's going to work. Rio Tinto, miner, also love them. It's not hard. It's like, look how good that channel is. You buy it when it's at 60, you sell it when it's at 70 or 75, whatever. Or you just keep it and wait. SoFi exploded finally. How many times have you heard me talk about SoFi in the last 2 years? See, and again, it's one of those things that you look at and I'm like, that's going to work. What they're doing is going to work, this online bank. And especially here, it was last year they got accredited. You know, they were granted a banking license. So they're not just an online bank, they're an online bank with a proper banking license. They're the first one that ever made that. And as soon as they got that, I was like, how could they lose? But people didn't believe it, and it stayed cheap all year long. And now finally, the numbers are coming in, and people are like, holy shit, these guys are going to be cranking out money. They're going 9.4 million people are now on their network. That's huge, and it's mostly small people. They go after students and stuff like that. There's 9.4 million accounts. They're going to add 2 million more accounts, 2.3 million next year. So they're going to have a 25% jump in new accounts next year. That's the kind of pace they're on. And the thing is, this is the kicker. The people who they are signing up are basically college students and post-college students, and they've got no money, but they're going to get jobs and get money, and they're going to stick with this bank because this bank is on their phone. And when kids get older, they don't turn into us. They don't stop banking by phone. They're going to keep banking by phone their whole lives. And more accounts will open up. And when their kids are born, their kids are going to get online banking because their parents are going to be like, who the hell banks at a bank? Who goes to a bank to bank? I haven't been to my bank in a year, I think. I honestly don't think I've been to my bank in a year. I have TD Bank. I've had no reason to go. I do more and more. They push me to do more and more stuff online. They don't want to see me. They don't want me dropping by. I used to go to the bank every couple of months, every month. I just feel weird not going to a bank. In fact, I'm thinking about it now. I'm like, I haven't been to a bank in so long. It's like, do they even remember me? Do they care? You know, but my kids, they've never met a bank officer. They would be very uncomfortable going to a bank and talking to people and filling out paper. That's not how banking works for them. Banking is click, click, boom, boom, move my money from here to here. That's how banking works. And this is a company that does it. They get it. So, you know, so no longer super cheap, but the growth is going to justify any number that they put up. Sony, really, really in a good place. They're a good, solid company. They're trading like 15 times earnings. They always trade at 15 times earnings. They're still a bargain. They're not a bargain when they get to 20, but right now they're fine. Simon Property is the mall guys. They were super cheap. We started at 124, now they're at 180. So 50% more. They're no longer cheap, but they're still a great company. SWK, not that exciting at the moment. I mean, they're good, solid long term. SYF took off. That's crazy. It's still cheap. It's PE of 8. Wow, that's crazy. There's another financial. We started 35. Whatever went wrong there. We started 35. Now they're at 64. So they've gone up a lot since we looked at them. But oh wait, they're not 64. Why did you say 64? They're at 50. That's not at that much. Only up 50%. But anyway. Great company, and also growing nicely, so that's a good one. AT&T, you guys know I love AT&T. They pay a really nice dividend. on top of everything else. And whenever they're cheap, you buy them. It's a no-brainer. They were cheap, we bought them. Now they're getting more and more in line. Target just got creamed. It's very, very tempting to jump on them now because they will figure it out. It will be okay. But you know, let the downgrade police have at them before we jump in. But if they, I mean, certainly this is a price. Right now, I'm very comfortable buying them here. I'm certainly comfortable selling shorts, TGT. So let's say we look at Target, and they're at 122 now. But see this, I can sell the $120 shorts for $18.50. So that brings me back down to 100. So even though they're 122, I can net in for 100 by selling the 120 calls. So it's going to put $18.50 in my pocket, and all they can do is assign it to me at 120. If Target stays above 120, I probably will never get assigned. I'll just keep the $18.20, which is 10% of the stock price. I could also sell the 100 puts for $10. That would net me in for 90. But I'd rather have more money. I'd rather have $18. Or 1850. I'd rather have 1850 and be assigned to 120 than only get 1050 and be assigned at 100. I'm not that worried about Target being below 100 that I wouldn't take the extra money. See, that's the trade-off there. But absolutely we like that. So we are definitely going to sell Target puts. We're just not ready yet. We're kind of hoping they go down a little bit more. We're hoping people freak out and drop them down even lower. TNBM, not that strong at the moment, so not like them. Trox, I love because they are titanium oxide. Titanium oxide. It's such a specialty thing, and they have so little competition that you're basically just waiting for the upswing in the industrial cycle. And so whether it's now or next year or the year after that, I certainly want to be in this company, and we have them, of course, but I certainly want to be in this company for the long term, and we'll take them when they get the upswing. And again, it's one of those things, when something's this cheap, you can do amazing things with the options. Because if you look at Trox, I think maybe they don't go out far enough, let's see. No, that's the problem, they don't go out far enough. But they go out to December 25, that's not terrible. And so, they're not going to pay dividends. There's no real reason to own the stock, and you can just go with like an 8-12 spread, which is let's say $4 and 175, so it's like 225 for the spread, for the $4 spread, and you can sell the $10 puts, and that's going to be at least 150. So it's going to be, what do we say, 425 times 150? So 425 for the spread, for the 10-12 spread, not the 10-12 spread, sorry. Oh no, the 8-12 spread, yeah. So the 8-12 spread is 225 minus 145, let's say, minus 145 is 80 cents. So you're spending 80 cents for the $8 calls, and you're betting it gets to 12, and you're going to get $4 back, and that's a $320 profit divided by 80, 400% profit. And you know what? Trox was a trade of the year runner up last year, which is interesting because this is where they were last year. They were down here. So we would have, this one would have actually worked. Our trade of the year was Vail. We'll get to those next week. But our trade of the year was Vail. That has not worked so far. But Trox would have actually worked because we were way the frick down here last year. And look at what they did. They exploded and then collapsed again. So we're getting another chance to buy them and another chance to make them a trade of the year. So now this is a candidate too. We got a couple of good candidates for trade of the year now. All right, so that's it. Wow. Okay, I got everything in up to the point where we did the reviews. We're going to finish these up next week, and we'll look at the bottom half of the stock. Somebody remember where we left off? And there are. I'm surprised how many really good things there are to buy right now. All right, so there's plenty of great stocks out there, and we have a lot of choices. and we're going to narrow it down and pick our probably 3 to 5 trade of the year candidates in the finals around Thanksgiving, and then we'll decide officially what the trade of the year for next year is. Oh, and as Kate says, the response for him doesn't mention anything about the probability of success. Even when he follows up, it's giving a generic answer. Okay, I don't know, Corey, I'm sorry, I don't know what you mean. Tell me in chat. So, yeah, the problem is that we have these extremely well-trained background bots that are running things. And so what's out of the box for me is not what's out of the box for you. So we've already modified them tremendously and taught them a lot of stuff. So you're not going to get quite the same response, but that's why I'm working on making a generic that will be able to box up or at least put in our chat room so you can use it whenever you want to. And I think that's going to be a big feature for us, is we're going to be able to let you do a lot of research using the bots that we use in our background. All right, well, thank you everybody for coming. I appreciate it, and we'll do this again next week. All right, take care.